Welcome to the inaugural Contango Income Generator Investor Conference Call. I'm Marty Switzer. With me today is the Portfolio Manager of Contango Income Generator, Shawn Burns. Hi, Shawn.
Marty, how are you?
Very well indeed. So, look, great to be here today. Great to have investors participating on this call. This is going to be a regular occurrence for the business and is part of an enhanced communication strategy that we're very focused on in terms of growing and building this fund. In terms of how the format's going to work today, I'll kick off the morning session by asking Shawn a few questions on the portfolio and how we're investing at the moment. And then this day is really about you. It's your chance to ask any question you want from Shawn about the fund or the portfolio. You can ask me any question you'd like about the broader Contango business. And that's basically the process. So, Burnsy, to kick off today, I want to get your sort of views on, I guess, the global macro environment at the moment. Markets have been volatile on the back of bonds, what's happening in the bond market, what's happening with things like trade wars, issues with China. What are the key things that are keeping you awake at night, and what's your view on the current macro landscape in general?
Yeah, no, thanks, Marty. I mean, I think things have changed over the last several months. I think, and the core of it is what happens to US inflation and wage growth, and I think that's the big question that is concentrating financial markets around the world, and it is a big question of how that goes. We've seen the bonds go from all-time lows to start to sell off as capacity utilisation starts to get hit in the States, like used up. Puts pressure on input prices. We've seen now a whole range of prices going up in the States, cement, transport, etc., all going higher, putting some inflation in the system. Importantly, not wages at the moment. That usually is late cycle, but people will be watching that very closely, and also what reaction, so the inflation rate and what reaction the bond market has to that. That's coinciding with a couple of other things happening as well. So as well as capacity utilisation gets used up in the States, which usually means inflation starts to come back from very low levels, but where does it end up? Also, you've got what's happening with QE, so QE is going to QT.
Quantitative easing we're talking about?
Yeah, quantitative easing going to quantitative tightening. The Fed slowly reducing its support for the fixed interest markets, the bond market, how it handles that. And then, so they're two big things. And finally, with Trump doing his changes to the tax laws over there, whether that adds extra demand as well, and whether that feeds into inflation. So you've got three issues that has to be that the markets are looking at and thinking, well, how will the bond market be impacted by that? Every time and people, we are in sort of uncharted waters to some extent. We're going from massive quantitative easing support for the fixed interest markets to withdrawing that. Now we're well and truly into 7 years into the up cycle for the US. What happens next? And you've got the fiscal initiatives from Trump sort of adding to the impetus as well. So that's a big question. If I had to know one thing in a year or 2 years' time, it'd be what's the US bond rate going to be? And
really, when we talk about inflation in the bond market, Burns, ultimately what we're sort of getting to is what's going to be happening with interest rates and the Fed's decision to increase the number of rate hikes, aren't we? That's at the core of it at the end of the day, and what that will mean for the broader economy.
That's right, yeah. And it also means has implications for the share market overall, and also sectors within the share market. So, as interest rates go up, those stocks that are more sensitive to interest rate movements are impacted the most.
Yeah.
Those which are least impacted are obviously impacted the least. So you have a sectoral shift that I think we've seen over the last couple of months. How far that goes and the length and the amplitude of it is obviously the interesting question from our point of view.
And are the reasons that those stocks are affected because investors, institutional or retail, will look to move out of those particular stocks into, say, a more defensive asset class because the returns are better, or are they affected because the cost of running a business is higher with rates going up? What are the sort of the key things that you look at or you consider when you say that there's going to be an impact for those stocks affected by rising yields?
Yeah, I think, there's a lot of ifs in this story, and we're a long way from being certain which way it'll go, but those stocks which can get, inflation, that helps some stocks, it doesn't help other stocks. It increasing interest rates, increases the cost of capital for certain stocks. If their top line isn't particularly sensitive to inflation, they haven't got a built-in hedge. So even though they're earning the same profits, if interest rates are going up, the alternative to interest rates starts to shrink between what they're yielding at the moment and where interest rates are now and in the future. So, so that's where and people will sort of shift to those which have, inflation type hedge in their top line, at this stage of the cycle. So, in some ways it is, we see this cycle go through, but every cycle is different. We don't know the amplitude or the longitude of it, but we are seeing a mix in the shift of what people want to hold. Some of them will sell, or also they're just lack of buying for some of these stocks at the moment.
Let's move on to the local front, and we've just got through reporting season. Give us the Shawn Burns report card on reporting season and what it means for our portfolios.
Yeah, I suppose you have to remember when we talk about CIE, we're talking a very specific part of the market. For the broader market, the way I look at it is quite simply, I just put it in three buckets. So you've got the bank bucket, which is 20 or 30% of the market. You've got the resource bucket, which is about 20%, and then the other industrial. So banks' profits are growing very slowly, very low single digit. So that's slow growth, but very solid. Resources really depends on commodities. At the moment, we're getting good upgrades. The iron ore prices has been strong, and that is the biggest influence on absolute profits in resources. So getting resource companies getting profit upgrades and good profit growth, and the rest are sort of chugging along at a probably mid-single digit, so doing okay. So I don't think there was any big shakes in terms of the actual numbers reported, but I think the big issue was that what we spoke about before, the influence of interest rates and the mix of stocks that people would like to hold and what they're willing to buy. In terms of like CIE, I think that it's probably this part of the cycle is probably the toughest part, where you have interest rate uncertainty, because we buy stocks which are less risky. That means they're more secure. That means they're easier to estimate. Usually their profits grow slowly and positively, but slowly. And as interest rates go up, they're probably a relatively close proxy for interest rates. So, as interest rates go up, it does take some interest in there. So I think that even though I've looked through the numbers of result season and what it meant in terms of dividends growing for CIE, and it was, I look through the numbers and they look pretty much the same as the last 6 months and the 6 months before. But you can tell that the market is not as willing to chase, is less interested in the stocks we hold at this point in the cycle. And that'll pass, and I think it's probably a good buying opportunity if that persists.
And who are the winners and losers, Burnsy, on a company level from the perspective of CIE?
Oh, we had a mix. There weren't. I got to admit, there weren't too many big winners. I mean, we had. You really need companies which are reporting well above expectations. The stocks we hold. Usually we don't like stocks that can report well above expectation. We like to buy stocks that we can sort of estimate and they're up a bit. So that's sort of been the we had a couple which increased their dividend a lot. Babcorp increased their dividend a lot. AGL increased their dividend a lot. There's only really two that decreased their dividend out of 32 stocks. So it wasn't a bad outcome. It was a reasonable outcome in terms of dividends increasing. But I think that some of the stocks that we hold that had average results. The market just obviously didn't like it. Gave them short shrift. So when that happens, what the way we invest, we hold companies with strong balance sheets. So when things go wrong for those, also we hold smaller holdings in those ones which are, where there's more of issues involved, and they can rely on their cash flow and their balance sheet to work their way out of it. So so it was actually this reporting season in terms of CIE saw the biggest divergence in share price outcomes. So that says to me the market's quite uncertain for yield stocks at the moment. So as I said, I think it will open up opportunities for us.
And Shawn, can you talk us through some additions and/or some refinements to the portfolio in recent weeks and months?
We keep. With CIE, it's more of a evolution, not a revolution. We do slowly, we sell some stocks that have done very well. So, we've taken profits in say, ASX, for instance. Adelaide, Brighton, we've taken some profits there over the last few months. Just looking down at, some of the car sales, we've taken profits there as well. Where we've sort of added, probably brought in SG Fleet. That looks like it was, treated quite harshly by the market. So we've added some there. We've also added some more Magellan. That sort of is been a bit disappointing in the share price stakes, but it's a great balance sheet, lots of cash flow coming out there. And also we've also brought in AMP into the portfolio. That's got a yield, big company, very stable, and
what sort of yield are we looking at with AMP?
I think grossed up it's over 5%.
Yeah.
So that's maybe high fives. I can have a look at that. That's sort of something new. Usually it's a top 30 stock, so just having a look actually, Marty, it's grossed up 7.7, so that's pretty attractive.
It's a nice yield.
So that it fell out of the top 30, so we bought it and put a position in that. So I think that 7.7% grossed up looked pretty attractive for a big stable type of company. But it is as I said, it's evolution. We don't move in big dramatic moves. We're going through all of the companies, looking at the cash flows and the balance sheets of all our holdings at the moment after results season, and reassessing which ones we think have moved up the risk curve and which ones have moved down the risk curve.
Yeah.
And we'll adjust the portfolio accordingly.
Burns, I think we've got a caller. Dre?
Yep, we have one from Tim Jones. Go ahead.
Oh, hi. My questions are specifically about stock. I'm wondering whether you held Retail Food Group or not. 12 months ago, it sort of would have seemed to be the kind of stock that would fit in a portfolio like this, being ex-ASX 30 and a decent yield up. But obviously with everything that's happened over the past few months, hopefully it wasn't. Was that held in the portfolio? And if so, did that hold the portfolio back, or can you comment on that?
Okay. No, thanks a lot for that question. This is probably, this is a topical stock at the moment, and it's probably worth going through. We've never held that stock, and I know it's a yield stock that people have held in yield funds, and maybe worth just going through quickly why we looked at it. We certainly looked at it, but why we never held it, and it comes to the sort of how the business operates. So those that don't know, Retail Food Group is a franchise operator, so it owns franchisees, or it leases out stores that are run by their franchisees. So names you probably know: Michelle's Patisserie, Dunkin' Donuts. There's a couple of coffee ones as well. So a whole range of large sort of like large franchise. Glory Jean's Coffee, that's another one. So names you'd recognise. Now for this business to operate, it's really the relationship between the franchisor and the franchisee. That relationship is pivotal. What worried us from CIE's point of view is your look through into what was actually happening in the operations is not very clear, and you really need to know that before you can make a assessment on sustainability and the strength of the business, and and also what is the terms of between as the head stock retail food group sells its goods to the franchisees, are they selling them at a price that the guys can make a living out of? So that just was hard to see from our point of view. So that raises risk in the portfolio, and also as this investment story, and also just the who and just the leases that because they're held by the franchisees, but as retail food groups stand behind them, how big are the leases, how onerous are they, etc. So that wasn't really clear. So there's a lot of off-balance sheet stuff that wasn't clear from, and so that sort of ruled it out from our point of view. We really like to have at least a feel of what's happening at that level before we invest. So. Yeah, as we said, we looked at it, but didn't participate.
Okay, and thanks, Burnsy. We've got another caller, Dre.
We've got Kevin Wilnoth. Go ahead, sir.
Hi, Kevin.
Hi, how you doing this morning?
Very well, sir. Thanks for your time.
No worries. We've heard the recent announcement about the opposition's policy with regard to not giving cash refunds for the franking credits for the low income earners. What do you think that impact will have on a share like CIE?
Yeah, I think that we'll see if it comes in and gets passed. There's a lot of water under the bridge to go before that happens. Also, just if you remember, if you're old enough like me, you remember when that didn't exist. Prime Minister Howard brought that in, or I think around 2000. Before that, when Keating brought it in originally, there was no cash rebate for shares. So shares were attractive, but this made them more attractive to a certain subset of the investing community, and those were those who basically don't pay tax. They're in sort of retirement mode, I suppose, and they get the cash, the pension phase, and they get the rebate for that. So I suspect that there may be some, and looking through the stats, it's very concentrated. The amount of people who get that, the bulk of it goes to very few people. Those people may change their asset allocation, but I just in terms of CIE, I don't think it'll really we're 50% franked. I don't see it as a big issue for CIE, and in terms of the companies that it's sort of back to the future, really. It's back to 2000. Franking shares still held an important part in the asset mix of people. Maybe those who are particularly overexposed will wind back their allocation to shares. If they are, people have a lot of franked income shares in pension mode, they may change their mix. I think that subset will be impacted, but I think the broader market will probably. I don't see it as a significant impact. That's sort of my view at this stage.
It probably increases the importance of an investor being well diversified across their portfolio and ensuring that they have the appropriate asset allocation to meet their risk profiles. CIE is a high quality product that we believe should be a core part of an investor's portfolio. But if you look at a lot of self-directed and SMSF investors, they are very underweight fixed interest and global. And so these sorts of things might mean that there is a bit of a reweighting from an overall asset allocation perspective. You think it's fair to say, Shawn?
Yeah. That at the margin, you'd say those guys who franking for that subset. I keep saying that for that subset becomes less attractive, so probably makes sense for them to divert some of that into other investments. At the margin.
Okay, look, we might start talking about ASX, Burnsy. So that's the top holding in the portfolio. What's the case for that being such a big weight?
Yeah, I mean we like that. We've liked it for since inception, really. I think probably. When we look at stocks for CIE, what we're looking for is strong balance sheets, sustainable businesses, businesses that are in a strong position, so hard to sort of get at them. lots of cash. Franked dividends is always attractive to us.
What's the yield on that, Burnsy?
I thought you might ask that. Marty. I'll just have a.
You got your
I'll have a. I'll just. But I think so from ASX, it's got a no. So here we go. So 5.5 grossed up.
Yeah.
I mean, it's sort of it has been higher than that. As I said, we have been sort of taking some profits in that. That share price has done very well for us. I mean, I think it's very it's a diversified business model. Gets its income streams. They're almost like a quasi monopoly. I know there is competition there at the margin, but it's very, very strong position, a long track record of steady growth. They can control their business quite well. As I said, no debt, lots of cash. I think it's the only real reason. Why would we sell it? We'd sell it if the share price went up a lot, as it could do, as it has done. It's done very well in the past. Or if it suddenly changed its spots, went out and made a big acquisition or something like that, and added a lot of debt to the balance sheet. We wouldn't like that. But as it's the way it is at the moment, I think it makes a lot of sense for CIE, and it will probably be a core holding. Going forward, and we'll just adjust the weighting depending on how high the share price is.
Burnsy, what's the stock that excites you the most in the portfolio? And I know you don't get very easily excited. But what's the stock that gets you really ready to rock?
Yeah, I mean, it's sort of, as I said, there's not too many ones that are going to double or anything like that in the portfolio. I mean, when I look at the portfolio, you look at that, those top 10 holdings, they're the ones that we don't want sort of, negative surprises from, or if they do have negative surprises, they're only little ones. So, so we've got, the two regional banks, Tabcorp, ASX, Perpetual, Adelaide, Brighton. We went and saw Adelaide Brighton's management last week, and I think that's a very solid story. Again, the share price has done well. IFL, they're buying that ANZ business. That's one we're looking at closely. When tracking that could be one that could be a bigger holding in the portfolio. We just want to see how we're just holding fire at the moment until. We hold it in the portfolio, but it could be bigger. We want to see how that ANZ acquisition, how those assets look closer to close date, which is later this year. And that management team has a very good track record of getting costs out, and they've rationalised a lot of businesses and brought them into the fold. That could lead to a quantum leap. If it all goes according to plan, they're talking to some like 20% increase in earnings. We rarely see that with our the stocks we hold. That goes all according to Hoyle. That could be a big winner for us over the next 2 years. A very experienced management team.
And we've got a call or a question, I should say, from Kevin.
Good morning again. Just a
Hi,
question
Kevin.
about the share price. I've been an investor since the IPO a couple of years ago.
Yeah.
The share price doesn't fluctuate much, which is a good thing in my portfolio because it adds stability. But it doesn't show any signs that it's going to break the dollar. And I know you've explained about the sort of shares that we do hold, but is that to do with the liquidity of it? And if so, is there any moves to try and increase the liquidity of this?
Look, I think that's a really good question, and I think what you're saying is very accurate. So, look, Contango Income Generator is a really nice fund. It's been very consistent, very reliable as a solid income provider in the portfolio. What we at Contango haven't done well in the past, and I guess it's part of the reason why there has been some changes in the business, is we just haven't got out there and told enough people about the CIE story, Kevin. And so that's a big part of what we're doing now. We've got a high quality fund. It's been running for a number of years. We've had consistent performance with a high quality manager, pays reliable income, 6.5%. and more people need to know about this story. And so we've got a strategy now where we're conducting events such as the one we're in right now, where we're trying to widen the audience of investors that buy CIE. We're looking at developing a number of relationships with a number of financial advisory groups who want to start recommending CIE to their clients, where we've enhanced our ongoing investor communications, which is all designed to get more people to buy it. We've got some options that expire at the end of the month, and that would sort of take away, I guess, one of the last sort of hurdles for the fund. And our focus is to grow this fund and make it a bigger fund, so it brings down the cost to investors, and increasing the liquidity is a critical part of doing that, because it's a closed-ended fund, and the only way you can grow closed-ended funds is by ensuring that you trade at premiums, and then look for ways to deploy capital management that's in the best interest of the shareholders. So we are focused on getting that share price above $1. Kevin, are you there?
Yes, I'm there. That's pretty much what I thought the answer would be, and
okay.
You're certainly on the right track in my view. Yes.
Oh, thank you, sir. Thank you very much. So, Dre, are there any more questions?
We have Will Thompson. Go ahead, sir.
Okay. Hi, Will.
Oh, hi, guys. I just had a quick question. So I'm an investor in the Switzer Dividend Growth Fund. So how does this fund work in tandem with that?
Okay, yeah, I'll answer that, Will. They're quite different. I think that
Shawn manages both funds, we should point out too. So that's my job, to manage those two. So the Switzer Dividend Growth Fund and CIE. I think to talk about what they have in common first, I think when we look at them, we have the skewing when we look at both those funds is for yield and quality. When we look at Switzer, Switzer's mainly top 100, so it is top 100 heavy, has big established companies, but we like to keep to the quality end. We like to keep the yield up above, well above the market yield, and but it is skewed to top 100. The CIE is X30, so it's quality and yield, but to the smaller companies, and so. That means that we're looking at the same thing. We're looking at cash flows. We're looking at sustainable businesses. We like, high frank dividends or high dividends, sustainable dividends. But CIE concentrates on that X30 space. So they complement each other. I mean, the crossover in stocks is not huge, because Switzer is sort of aimed at much bigger companies than CIE, but so CIE is basically the complement people who hold the stocks that are in Switzer, like the big banks, Wesfarmers, Woolies, the big REITs, etc., the big miners, BHP, Rio, etc. So CIE is meant to complement those big holdings, but both of them are focused on yield, the gross up dividend yield of both portfolios above 6%, but they both focus on yield and quality. But CIE is X30, so smaller companies, and Switzer is the bigger companies. Hope that helps, Will.
No worries. Thanks a lot for that.
Okay, Burnsy. No questions for now. Okay. Well, look, we might just touch on a stock that you do talk about regularly, is car sales. You've taken some profits on that recently, but is that still something that will be a core part of the portfolio?
Yeah, I think that car sales, how we got involved in car sales or put the investment in car sales is just interesting, because if you go back long enough, car sales was a glamour stock, which means usually it has no yield or very small yield, because the share price is so high. So I thought, there's no way we're ever going to hold a stock of the quality of car sales quality. And then, if you remember a few years ago now, there was a News Corp who owned a potential competitor that sold it to a US company, I think it was called Cox, and there was fear that they would ramp up competition against car sales. share price fell, and it fell far enough for us to be interested in it. And there's obviously a couple of assessments you have to make there. Is that how real is that competition? Is the main one. When we didn't think, and we thought not very. And then you had a look at the company itself. Hardly any debt, lots of cash flows, dominant position in the industry. It starts to sound a lot like ASX type story. That's stocks we do like. So we ended up buying our position below $10 and put it in the fund. It was at that stage it was yielding a very attractive yield. Obviously, how that's panned out. I mean, the competition really hasn't come to a head, and the share price has recovered. Now it's around $14 or something of that order. So $14 to $15. So when that's a happy story. That's a good story for us. What we like to see is our companies grow out of the fund where their share price is so strong, the yield drops that it's not attractive to us. So we start to take profits. And I said it's a evolution, not a revolution. We just will slowly reduce that position. I mean, you can't get too sentimental with these stories, even no matter how good the stock was to you. At some point, if it is yielding, if it goes back to being a glamour stock and yielding 1 or 2%, then it'll probably disappear from the portfolio. Thanks, Marty.
Okay. Yep. So look, if there aren't any more questions, then we might look to wrap up the session. So now is your chance to ask some questions, ladies and gentlemen, because we do need to get Shawn back to running the portfolio. So are there any more questions out there?
No questions here.
Okay. Well, look, thank you very much for everyone's time this morning. We greatly appreciate and are very grateful for the support that you're showing us to manage your investments for you. Look, this recording is going to be uploaded on our website today, so if you want to hear anything again, then it's going to be available at contango.com.au. CIE is a high quality fund, a high quality track record. The ASX code, if you're not an investor and not sure, is CIE, and it is trading at a discount at the moment, so it is a good time to buy the stock. We're very focused on growing and building this particular company, and we're very focused on that. So we do have another question though, which is great, and we've got a few more minutes. So next question, please.
You've got Kevin. Go ahead, Kevin.
Kevin, how are you, sir?
Great, thank you. You mentioned before about the options expiry.
Yeah.
Will that can that have a positive effect on the share price, or what happens when I realise that they expire on the end of March?
Yeah.
What's the potential effect on the share price after that?
Well, look, I think ultimately, and I might throw to Burnsy for his view on that. But there's some investors believe that when you've got the options hanging over your head, it can have a dilutionary impact. So once you've got that clear, it gives you the opportunity as the manager to focus on building the business and growing the business with no dilutionary impacts around. So, Shawn, do you want to contribute to that?
Yeah, Kevin. I mean, there's a couple of theories that what will happen once that disappears. I think that you have to remember that for every option that's expired means that CIE will get $1 of value in. Now, at the moment, the NTA before tax is $1.008. So that doesn't dilute the NTA to any meaningful degree at this stage. So that's good. I think that when options are out there, sometimes they act as an overhang, because people are worried that if the NTA suddenly shot up, that people would exercise and dilute them. So exercising that, getting that out the way will remove that risk, even though it's probably only a low risk. And I think that, and growing the fund is a good thing, which helps fractionalise the costs of running the fund.
Increase liquidity.
And increase liquidity. So I think it's, so it's a good thing, and, hopefully we end up getting a bit of money in for that. It's a good outcome for existing shareholders, the way it has panned out.
Thanks for that.
Okay, well, look, if we don't have any more questions, we'd like to once again... Okay, thanks, Dre. I'd like to thank you for your time, and the ASX code is CIE, and we'll be running these teleconferences or investor calls on a quarterly basis. We'll be giving you updates in our twice monthly email communication about when they're going to be on. If you have any questions for me, you can call me at any time. My number is 0407 297 702, and thank you very much for your time.
Thank you.